One of the best uses for hard money is renovation funding. If you have a rental property in a market that's quickly appreciating, a high quality rehab can be a great way to maximize your investment returns. Let's imagine you have an investment property that you've been renting for the past 10 years. You bought the property for $100,000 with a 15-year mortgage, and over the past decade, you've had a mixed bag of good and bad tenants. In the past 3 years, the neighborhood's changed, causing property values to soar. You decide you're going to sell after receiving notice from the current tenant. Great news. In most gentrifying areas, or gentrifying neighborhoods, I should say, renovated properties are going to sell for significantly more than rental grade homes. In your case, the resale value of your as-is rental is around $125,000. The property could be worth as much as $225,000 if properly rehabbed. So you decide to renovate the property to realize your highest return. Now, the cost of the renovations are about $60,000 and should take about 4 months to complete. We'll assume that your rental property has an existing mortgage balance of around $45,000. So you're going to need a total of $105,000 net from any loan. That's $45,000 to pay off the existing first mortgage and $60,000 to fund the renovation. Now, traditional lenders, they're going to limit their refi loans to around 80% of the property value. Since the current value of the property is around, $125,000, a loan of $100,000 just isn't going to get it done. One benefit of using a hard money lender is that they'll often base the loan on the after repair value as opposed to the as is value. In this case, that's $225,000. So even at a 50% loan to value ratio, which is very, very conservative, there's plenty of money to get the project done. While applying for your hard money financing, you'll provide a scope of work for the proposed renovation budget. Different lenders have different forms and requirements, but often this process is pretty simple. It'll include a list of planned upgrades as well as a cost for each of the items. You'll also want to include a draw schedule, which will segregate parts of the project into various phases. For example, let's say you plan to put a roof, install some windows, complete some demolition, and install some minor framing in the house. These items will be the first part of the renovation and total $15,000. They'll take about 1 month to complete. Now, this is phase one of the draw schedule. Pretty simple. Once the loan's approved and closes, the first mortgage will be paid off. In addition, the lender will often fund the first phase of renovation, draw phase one, in the amount of $15,000. For the remaining $45,000 of the renovation, the lender will complete inspections for the work as each phase is complete. Funding for each phase will then be released as the project gets closer and closer to the finish line. In this way, you can add about $75,000 in value to your investment property for a few dollars in lender's fees. It's a great way to leverage your equity and increase your profits.